Assalamu alaikum. My name is Muhammad Hamzullah bin Nasib. I am a financial analyst. I'm here to present the report on the company Engro Corporation. And being an analyst, and if you are an investor, and it's your first, basically, a recommendation that you want to know about the company. Basically, Engro Corporation is a conglomerate a business. It started in 1965 as a fertilizer business. After that, they started growing in each department where they started the energy, and then they started doing different different niches in the businesses. And now it's a conglomerate business. Now, if you are interested to invest in the company, you must know about this that how well is the company performing in these recent years. Let's start. Let's take a look on the screen, and from the very first view, you can see that here is basically an profit or loss statement, which basically describes the it describes its expenses, its sales, its revenue, its cost of revenue, each and everything about its profit or loss. So from the very start, the data basically we have taken you can say the company annual reports. So these data basically basically contract that data and put it in the Excel file, and you can see that it's in rupees, and the data is given here from 2019 to 2022. So from very start, their revenue is very good. They are increasing their revenue. It's a good sign as an investor that they are performing good in sales, good in revenue. After that, you can see that basically the expenses basically are increasing. Yes, in a company when they started doing operations, they need more. They spend more money on expenses. So sometimes the expense is a good sign. But from here, for the deep understanding to know that how company well perform, so we must check the all the ratios, to verify our answers, such as profitability ratio, efficiency ratio, liquidity ratio, and gearing ratios and investment ratio. So let's start with the balance sheet. And balance sheet, as an investor, you must know what is the balance sheet. Balance sheet basically is a representation of a financial position of a company. That what is the position as a financially? What is the position of the company? So in financial statement, there is always financial positioning statement. There is always assets, liabilities, owner equity, which are basically connected with each other. By accounting formula, you must know that assets is equal to liabilities plus owner equity. So that's the point. You can see that it's a complete data of balance sheet, which I extracted from the annual reports. So here basically I use some you can say all the data. I am not having an extract from the annual report, where we need the calculations on you can say on the financial positioning statement. We do our calculation, such as for our current assets, we'll do our calculation, which is C5 plus C27. So here is basically the calculation of our total assets, total current assets. So here you can see that C25 is basically here, and it's an you can say that it's the current asset plus all the non-current assets I have added. So it is the conclusion for total asset, not for the grant asset. I must say, do a mistake and I will correct it to the total assets. So from here, we can presume that it's basically you can say such an activity to improve to show you that I have done my calculations with other aspects, and here you can see that there is all the data, all the heads are available from the financial reports. You can check from the annual reports of the company Engro Corporation. Now let's look at the main points where we consider it's an feasible company to invest or not. So that's our main concern. Let's start with the profitability ratio. You know that profitability, return on equity, return on capital employed, operating profit margin, gross profit margin. As you know that here I have concluded these from our previous data extract from the balance sheet and profit or loss statement, where it is needed, such as you can see that here I apply the formula from the profit or loss statement and balance sheet. You can see on the graph that it shows an increasing effect till 2021. But after 2021, it started to decrease in 2022. And if you check all the other ratios, you can check that they started losing their. If you check it on an overall basis, it's increasing. It's an increasing trend, which is a good sign. But something happened in 2022. We must check the incident on the behalf which the company shows such a decline effect. So after the profitability ratio, we go on a efficiency ratio. Efficiency ratio tells you about the average, what your company's output, what is your company's output. So from here we can see that these are the company's output from minimal minimum inputs. So let's check the data from 2022 to 2022, 2020 to 2022. Basically, this data is, you can see that shows an increasing trend. It's an amazing sign and good sign for the investor that you must spend. It's a feasible thing, and you must have to apply on these. You must have to spend your investment, but we can't conclude on a single ratio. We have to make a comparison on behalf of every ratio, so we can check its feasibility from all the aspects. And that's our main concern. Let's start on the liquidity ratios. Liquidity ratio basically tells you about how the company will manage to fulfill the, you can say, the responsibilities, obligations, or you can name it as liabilities. These are basically representing that. Is you can see that shows us some declining effect from 2020 to 2022. But that sign shows a bit concern for ourselves, because the company started to raise their liabilities on aspect of asset. But the company is a well-known company in the country, and it's you can say the overall top company in the country. So you can say that the things are a little bit different in different perspectives, different things. If we go on a liquidity ratio, it's a bit concerning for ourselves, but not so much, because you can say that you can see that the ratios are much more than 0.1%, basically decimal. So it's a good sign for ourselves that companies taking some liabilities to perform this function, which you can see that on an efficiency ratio, that their output are going increase, shows an increasing effect. It's happened because they take some risk, they take some liabilities to get more output from the minimum input. Yes, they increase their inputs. Sometimes it's required for the business functions. So overall, from you can see that uh, till now we can assume that the company is a good company. You must invest in this company. But as I already told you that we can't conclude on some ratios. We have to cover all the ratios. Then we reach on our conclusion. Let's take a look on a gearing ratio. Gearing ratio basically explain you about the company. You can say that the company main what the company have taken, what the company have taken the debt, how much company have taken the debt. This is basically shown in our gearing ratios. As you can say that the gearing ratio shows very minimum increase, very minimum increase. It's not about their that they didn't attain the debt, but it's a good sign because they started increasing their profit as we see in our profitability ratio and also in the profit or loss statement that the profit are increasing at exponential rate. You can say that it's an exponential rate, and they're starting to giving more interest. That's why they started to increase their debt and performing as well as before. So after the gearing ratio, you can see that in interest coverage ratios and gearing ratio shows some decline effect, but it's not the appropriate that we can say the company are increasing so much debt. It's not quite that. In Pakistan, a lot of companies taken debt about 80%, all about 80% and spend 20% in it. But the Engro Corporation just take 49% and they start giving their interest very well. And you can see that these basically these percentages are very minimum as compared to industry standards. So now let's take a look on investment ratios. As you can see that investment ratios shows us some increasing effect uh, in a dividend payout ratio, dividend cover ratio, dividend yield ratio. It shows an increasing effect. Basically, it shows you that they spend more money to fulfill the need of their investor to increase their wealth, to maximize their wealth. So, as an investor, it's a most important, basically a most important ratio which explains you that the company giving you more attention to the shareholders, and it's a good sign for the new investors. So you must have to apply on these basically you must have to take in an investment in the company Engro Corporation, and you can see that yes, it shows some decreasing effect in a price earning growth ratio. It's because their prices are increasing generally at more than their growth. So their growth must be sure some decline effect, but it's I think it's a preferable because the growth is not totally concerned with how much you have gain, how much you have is more, how well you spend on your shareholder. It's just an a growth which may started to increase or decrease because in the Pakistan in the market basically shows some variation. Sometimes it show positive growth, sometimes it's negative show. But as an investor, as a long-term investor, you must have to focus that in a long-term point of view, that what the company offers to you. And because we have already seen all the ratios in this report, and we can now conclude ourselves that how well company perform. I think it's a more very preferable company to invest, and it's a feasible option than any other options available in the market, according to my report. So it's not a basically my report. It's a basically the ratio. It's a systematic way. So system does not tell complete truth, but doesn't tell a complete lie. So it gives you some certain amount of belief that you can invest in this company. So these ratios show give us some belief to invest in this company. I think as a financial analyst, I will prefer you must take an investment in the Engro Corporation. I hope that's a very good report from my side, and you must take an investment in the company. Thank you so much.